timing seems to go unmarked and unnoticed. But bad timing, well, that seems to rear its head in ugly, in painful, and emotional fashion. And today we're going to talk about timing, specifically timing the market. And I think one of the big questions that I would be asking myself, at least if I was listening to this, is, am I actually timing the market without realizing it? So we'll go through that today. My name is Michael MacKelvie. I'm a certified financial planner. I'm joined today by Valerie Escobar, who's also a certified financial planner with Mariner Wealth Advisors. This is Your Life Simplified. Valerie, how we doing?
Good. How are you?
I'm doing good. And I think the recent volatility makes the episode Embracing Volatility a good one.
It is, yeah. And it's always interesting, when we talk about volatility, technically that's ups and downs, but nobody actually has a problem with the ups. It's the downs.
Yeah.
And so, yes,
Good
definitely
point.
the recent downside is what is making people a little sick. And so really embracing it, figuring out, well, what do we do with it? And what have we learned with our past experiences about what volatility really is about? I think it's perfect. I think it's something we should all keep in mind because our emotions can take over.
Yeah, that's a great point. It's interesting, the connotations that are involved with volatility. We don't think volatility, the up or the up and down. We think just the down. That's typically how it's thought of. Maybe that's the news industry just kind of rephrasing the word to maybe not sound quite as bad. But I don't know. I'm not really sure. But I know you have some stats and just some numbers to start with here that are pretty interesting.
Yeah. I mean, I, as a, finance nerd, I think that these are pretty good. And just that you go back to it. One of the things to really remember is that historically a bull market. So when we say bull market, we're talking about the market moving up in general, that we're increasing our price returns. Bull markets tend to last an average of 8.9 years. So about 8 to 9 years. And over that period of time, you'll have a cumulative return of 468%, which is crazy if you think about it. So that's not every year you're not making 400%, obviously, but from point A, beginning of the bull market to the end, 468%. And that's like if you stay in all of it, right?
Right.
That's not just picking and choosing, that's doing the whole thing.
Right.
One of the things that we'll notice with clients and probably for ourselves, right? We get halfway through and we either think that this is going to last forever or we forget what the downside looks like. And so, once we start to see a pullback, we think this is the end, the sky's definitely falling. We're never going to recover from this. But the other piece of the other statistical nugget that I think is really interesting is that the average bear market lasts about 1.4 years with an average cumulative loss of negative 41%. So 41 hurts,
steeper.
Right? But if we compare that to a positive 460%, I mean, it's a drop in the bucket.
Yeah. It's steeper and quicker. And, you have to wonder with that, how much of that is just, obviously everybody kind of jumping in on the sell-off, the prospect theory of losses, being a larger emotional impact than gains and causing maybe a little bit more trading. It's interesting to look at that and, just see those numbers because obviously they are, the bull market, both in length as well as just total return, is so much larger. But, I think this question kind of exists out there of, are people timing the market without knowing it? And it's very rare that I have somebody just kind of admit to saying, yeah, I want to be a market timer. I mean, I don't remember the last time that I heard that, but, you've maybe caught people kind of saying some things that are like, hey, that's actually, you're actually alluding to timing the market. When we're rebalancing, let's say moving from one asset class, we'll say stocks to bonds, and you're maybe changing the weight of your portfolio, you're not just rebalancing to keep the same weight. The question exists there, is that market timing in some sense? And, I guess that's, somewhat debatable. But I think a lot more people are actually timing it than they realize, right? Maybe they're just living a life believing that they're just kind of sticking to it, but they actually are jumping in and out much more frequently than they realize. But you had some different pieces, some different things you wanted to share on the impact of just some different days in the market. And we're speaking days here. So you started with years, but we can get a little bit more granular with days. Is that right?
I did, yes. And I thought, a really fun way to present this is to kind of use you as a guinea pig.
Yes.
As someone that, you've been around the block, I can see all those gray hairs on you. So I thought it'd be fun to kind of use what your experience has been. So let's say, I'm not going to tell you the year, and this is history, right? So this isn't data.
For the record, I don't know what you're going to share with me, for the record, but I'm excited.
Oh yeah. Okay, good. So
that's how it should be done.
Yes, as an investor, you've been going along this year so far, and let's give you a good round number. You have $1 million, right? This year so far, you've lost 11% on your $1 million. Okay. So it hurts, right? And so now today is March 9th or March 11th of this year. And you are not a market timer, but for now, maybe it would make sense to decide if you want to stay in or out. Okay.
Right. Yeah.
And you're a pure equity guy. So March 11th of this day, the equity markets, the S&P 500 is down before I say it, you're down 11% year to date. I'm not going to give you the answer ahead of time.
Okay.
You wake up, are you going to stay in or out? You've already lost 11% so far.
Yeah. Well, let's just say I bounce out.
You're going to bounce out. Okay.
I'll bounce out, and I'm going to collect myself and assess the situation. Okay.
So this one, you're down another 4.89%. Okay. So March 11th of this day, we lost another 4.89%. Okay. So I'm
feeling pretty good.
Feeling good. Okay. Next day, March 11th. What are you going to do? Stay in or out? Or you're going to get back in?
I think we're down 4 point, but just my gut is telling me that this is going to keep going down. I actually just read something that some analyst out of North Carolina that I've never met says it's going to be a bear market in a week. So I'm going to hold out.
Okay. All right, cool. So we're down another 9.51%. Oh, you're killing it. You're killing it.
I'm doing good so far. That guy in North Carolina, man, thank you.
He knows what's up, right? Okay, now we're third day in a row. I mean, this bear markets, when we're talking about bear markets, we're talking about 30% down, right? 30 to 40%. So now we're about 20. Yeah, we're about 25% down. So March 13th, what are you going to do?
The first thing I'm going to do is I'm going to go to all of my coworkers and tell them how right I've been the last couple days. And then I'm going to tell them if they have any sense, they should start listening to me both at our work, but also just with money management. So that's the first thing I'm going to do. The second thing I'm going to do, I'm going to hold out still.
Okay. All right. This is the day that we made 9.29%. So this day, missing this one day, makes up half of the total return you would have made this year. The year we're talking about is 2020. And for the whole year,
I remember that
positive 18.4%. So half of it was made on this day that you are not in the market. How are your friends feeling about you now?
Well, I'm going to double down and just say, hey, it's dead cat. Don't worry about it. Don't worry about it. Okay. That's everybody else, but that's not us. So I'm going to double down and just probably stay out. No, I actually remember that day. I think everybody does. I mean, obviously it was, speaking of volatility.
If you're a student of history, if you're in this industry, right? And this was so painful back in that day. But gosh, with COVID, it was the same thing, right? All of a sudden we were seeing this incredible drawdown. And I have clients that define themselves as prognosticators. They know this is the end. And that's always what it is. This is the end and I got to stay out. And then all of a sudden the recovery happens and you didn't know it. It's a dead cat. Like you said, what's a dead cat anyways, Mike? Explain that to me.
Well, I might leave that to, I try to stay away from those types of phrases and really define them because, I really don't use them. And, so I maybe just kind of leave that to, the forums out there, and they tend to change as far as like their meaning year to year. But I think, and help me if I'm wrong on this, but from what I understand, it's not a realistic bounce. We haven't really reached the actual bottom, right?
Right. Yeah.
It's a false bounce.
Right. Yep, exactly. And I think it's something the media likes to say.
Yeah.
It's just a dead cat. It's a this or that. It's some descriptive term to make people
feel
have
bad for cats.
Reaction.
Though. You got to feel bad for cats in that situation.
I
yeah.
know. What about the cat lover? True.
But yeah, I mean, you have to be right twice. It's obviously it's not just the decision to get out, but obviously that comes with the decision to get back in, which is just incredibly challenging. And I don't know if you had any other days to throw at me, but
no, I think I've beat you up enough.
Yeah,
well, lost a lot of money.
Well, I think I guess let's just say I continued on there, still preaching to my coworkers each day. I wouldn't be sitting sitting in a pretty good position, even if we consider what's happened here to begin in 2022. With that taken into account, still the market is up considerably from that point in time in 2000, right? Which is, I don't think what anyone was expecting. I think most people were looking at it and saying, okay, the stock market seems to be experiencing all this, but like there seems to be all of these things that are going wrong. Everything sucks right now. Why is it that the market is going up? And then it just obviously kept breaking new grounds. And even if we take into account what's happened here in 2022, you'd still be in a much better position than myself, check it out, North Carolina analyst and preaching to the coworkers, right? So, I think one of the big questions I mentioned in the beginning is just like, are you actually timing without realizing it? And what's captivating to me is our unlimited ability to ignore our own ignorance. So this is a common statement that I hear from a lot of people, right? Hey, I know I shouldn't time the market. That's everybody else, but I don't really want to do that. Then 30 minutes later in the conversation, hey, our company stock's at 60 right now, but it was at 75 last March, and I feel pretty good about where we're at right now. So I think I'm going to hold on. It's interesting how those two statements are usually found in just about every first conversation that I have with someone. And we are quite well equipped when it comes to pointing out others being irrational, others being ignorant, or others having oversight. But what about ourselves? Myself included, by the way. You might even tell your story, tell yourself a story of rebirth, right? So like, for example, I used to be emotional or ignorant with the market, whatever it might be. But then 2008 happened and I lost a bunch of money. And now I don't do that anymore, right? And it's not that we can't learn from experience. It's just that, as you sit there and kind of just, I guess, evaluate and assess yourself, is it possible that in an 83-year-long life expectancy, you could be overlooking something? You could make a poor financial decision at some point in time. Is it possible that you might not be in the same emotional state of mind that you're in right now for the rest of your time? That you could have a loss, that you could experience something that maybe puts you in a different mental state, like a divorce, like something in your business. Is that possible, right? Or is that just everybody else? And, I think at the core of all of this is we seem to believe that we understand the past and we can apply that to the future. Mm-hmm. But in reality, we don't really understand the past as much as we do. And our inability to properly reconstruct those past events, that causes us to underestimate the surprise that came with them, the continual surprise that came with them, right? So I think I really see that is the core reason why maybe people look to time the market is we look to the past hey, that makes sense now. We can apply that to the future. And then we just keep getting surprised.
Right. No, agreed. And I mean, always having that another person to talk to about it is extremely helpful to make sure we're not getting caught up in some of those cycles. But what can we do? To me, I like to have an action. Like, don't just tell me to hang on and do nothing. That's no fun. So what can we do? One of the really big things is dollar cost averaging. This strategy means that you are slowly putting money in a little bit at a time. And this is something that works really well when the market's moving up and down. So let's say, today, especially when with 401ks or any kind of retirement plan, if you're systematically making contributions. So let's say you put in $100 every other week, market's slowly going down and down and down. It's like going out and every single, every 2 weeks you're going out and buying a TV for some reason. But the price just keeps going down and down and down. And you're, stockpiling these TVs, and eventually they're going to increase in price again, but you bought them on sale. So looking at stock market being on sale, I think is a really nice way to kind of help yourself feel better about it. So dollar cost averaging, huge strategy right now. The other thing that we know from history, like you said, that bear markets lost between on average 1.8 years, so 1 to 2 years. One thing we are advising clients is to really have their store of cash for those 2 years. And so I saying, if I happen to lose my job during that time, if I happen to, my car breaks down, I need a new dishwasher, something happens, we've already got that cash on the sideline so that we're not selling during a recession, during that, or a bear market. Because that's really the last thing we want to do, is just to really discipline ourselves and tell ourselves we will not sell in a bear market. And so if I've got the cash, I've got no reason to sell aside from being afraid, afraid for my emotions getting the better of me. And the last one there's lots of strategies, but the last one I wanted to mention is tax loss harvesting. And I think we've talked a little bit about this, but that's effectively where we, our equity piece, there's certain stocks that have lost money. We go ahead and sell that and use that loss to reduce our taxable gains that we might have, or tax liabilities. And we invest that money into a different stock that also has growth potential. So we're staying invested in the market, but we are also, taking the silver lining of a tax, not credit, but, kind of a tool that we can use against tax liabilities to help ourselves in the future.
Yeah. I think, obviously those are all, definitely good ways to, as you mentioned, weather the storm. And I think it's also just kind of taking a breath before you make these decisions, obviously slowing down. And that's where having someone can help you. But, you're going to be in these situations likely several more times. And I think taking a breath and just kind of looking at, okay, what else is it that I have working for me? Mm-hmm. I find myself revisiting those conversations so frequently with clients. Hey, this is why we set up this and this as well. You don't have everything in the S&P 500. That's not your entire financial existence. And I know that seems, again, so simple, but as we've talked about so many times, that doesn't mean that it's always easy to do. Mm-hmm. We're humans. And I think having some intellectual vulnerability and saying, hey, I'm probably going to have some emotional moments like this, I should institute some type of way to slow myself down, is a good strategy. But Absolutely. All of those, definitely help. Dollar cost averaging certainly helps reduce timing risk, because you're just increasing the amount of times that you're investing in the market. Mm-hmm. One piece that I found pretty hilarious, but also just at the same time insightful. Fidelity was doing a performance review of just some different accounts in which investors received the best returns from 2003 to 2013. So they were trying to figure out why some consumers were doing well on the retail investing standpoint, what was really setting them apart. And so they did an audit and they looked at all of these different variables. And
okay, so whatever the study that comes up with is what we as retail investors, we should totally replicate this strategy.
Right.
Okay.
Yeah, exactly.
Go.
So that's what they were looking at again. So what really separated good retail investors from bad? And again, retail investors, just people that are investing on their own, making their own decisions, right? And they found that the people who switched jobs and forgot or were dead did the best. So one strategy for investing well is just dying.
So being dead or pretending like you're dead are the best ways to be.
I thought that was
investors.
I thought that was both hilarious, but also so, insightful. Again, so the people that had the best performance in the retail side, so just had personal accounts with Fidelity, like what really separated them, and they were inactive or dead. And what does that tell us? It tells us again that the number one reason why we maybe fail at being successful from an investing standpoint is just our own consumer behavior. But so oddly, and this goes back to what I was saying earlier, we all seem to view ourselves as the exception.
Mm-hmm.
So I think in conclusion, embracing volatility, I don't think that really has to do with knowing the probabilities. It doesn't have to do with knowing, hey, I know I should be invested for the long run. I know that I shouldn't try to get in and out as these sways occur. I think it's much more about having that intellectual vulnerability for saying, hey, at some point I will be human. It's as if we just follow this first rule of economics that's, they teach us in school, which is we're all rational beings, and think that we aren't prone to error, right? Which is the rule that they speak to in traditional economics. Behavioral economics looks at it and says, well, we're maybe not that rational at times. There are going to be points in your life where you are human. That's a good thing, but it can also be a bad thing in regards to your finances. Coming back to the numbers on just getting in and out of the market and how challenging that is, I think revisiting that is a great strategy, but also just knowing, again, I'm probably going to be emotional at some point in time. I should probably institute some elements of control to help curb my behavior and create an environment where behaving well is easier.
Mm-hmm.
So, hope you enjoyed today. Again, I'm Michael MacKelvie. I'm joined by Valerie Escobar. Make sure to hit that subscribe button wherever you're listening to this, whether it's Apple, Spotify, on YouTube, wherever it is, to learn more insights from industry professionals here at Mariner Wealth Advisors. This is Your Life Simplified. Take care.
Bye.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP, registered trademark, certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.